All right, let's just dive right into this explainer and explore what is honestly a fascinating contrast. We're looking at the wealth-building, handshake economy of the past versus the totally frictionless, but kind of isolating algorithmic finance of today. I mean, we live in an era where, you can get a personal loan in 30 seconds from an app on your phone. But that app, it doesn't know your face, it doesn't know your family, and it definitely doesn't know your character. The sources we're digging into today make a really compelling argument. They say that while the friction of banking is completely gone, so is the social capital that actually built the middle class in the first place. So, today we are unpacking the 20 lost methods of community banking and mutual aid that back in the day made ordinary neighborhoods practically financially invincible.
Just think about this for a second. A simple handshake at a 1962 Rotary lunch often built way more generational wealth for middle-class families than any modern networking app or, cold LinkedIn pitch ever could today. Back then, trust was literally your collateral. You didn't just have a 3-digit credit score, you had a reputation in your town. Fast forward to the 2020s, and that exact same local entrepreneur is often just flat out rejected by a blind algorithm, or they're forced to swallow a massive 29% APR from some anonymous fintech company. The source material points out a really crucial pattern here. As our financial system scaled up and became hyper-standardized, we lost those localized, community-vetted methods that actually kept the money circulating in our own backyards.
To really wrap our heads around what we lost, the explainer groups these into 3 distinct families of banking. We'll kick things off with the first one. Family 1, the original, hyper-local credit unions based on a strict common bond. Okay, so the first 4 methods here relied entirely on social accountability. Picture working at a factory back in the day, where your single sponsor, employer-based credit union meant the guy working next to you on the floor was also your teller. Default rates were incredibly low because, you had to look your fellow members in the eye every single morning. Then you had the Passbook Christmas Club, a strictly enforced, fee-free savings mechanism. And if you needed money, you got a character loan. No FICO score required, you just grabbed a cosigner from the break room. Finally, Method 4, the Burial Club. If tragedy struck, this functioned as a super tight-knit mutual insurance pool, taking small monthly amounts to cover the funeral costs for anyone in the circle who passed away. It was all about having each other's backs.
But as you can see here, we've kind of traded those brilliant community tools for really expensive modern traps. Method 5, school savings banks, literally brought physical banking right into classrooms to teach kids actual financial discipline. Compare that to today's digital literacy apps that kids barely use. Method 6, cooperative housing circles, allowed neighbors to bypass Wall Street entirely. They pulled money to fund each other's home loans. Today, institutional investors are just buying up massive swaths of single-family homes. And Method 7, 0% layaway loans. The local hardware store had absolutely no incentive to gouge you. But today, we've got buy now, pay later apps hitting consumers with 25% APRs and all sorts of hidden late fees. It's a totally different ballgame.
Let's transition over to our second family of lost methods, mutual savings banks. If the credit unions were member-owned cooperatives, these were basically the original crowdfunders.
Now, the source material makes a really big deal out of this definition. Because these mutual savings banks answered directly to their depositors, rather than to some Wall Street shareholders 1,000 miles away, they could intentionally keep interest rates low. They offered incredibly stable loans and even capped their executives' salaries. Their incentives were perfectly aligned with the actual longevity and stability of the neighborhood instead of facing that relentless pressure to hit quarterly profit targets for distant investors.
So, what did this look like in practice? Well, Method 8 was the thrift institution with member ownership, meaning your local bank returned its profits directly back to you as a dividend. Method 9 is wild to think about now, the passbook loan. You could literally borrow against your own savings at a tiny 2% interest rate with zero underwriting friction. But Method 10 is the real kicker, the Neighborhood Advisory Board. Local leaders reviewed your loan. They knew if the town factory was avoiding layoffs or if a seasonal business just needed to float until spring. They priced in the human context, not just a blind statistical credit score. And that human context offered a kind of safety net you almost never see today. Method 11, penny savings accounts. Let kids build lifetime habits with absolutely no minimums and no hidden fees. Method 12, the Cooperative Hospitalization Fund, acted as the original HMO. They paid hospitals directly from a pooled community fund, completely removing the profit motive from healthcare. And Method 13, this one is just incredible. The bereavement notice automatically suspended a widow's loan payments for a 90-day grace period if her husband passed away. Basic human empathy was literally built right into the math of the loan. Moving right along, let's look at the third pillar, Fraternal Lodge networks. Now, when I say that, you might picture guys in funny hats doing secret rituals, right? But the historical reality is that these organizations were the original social network insurance pools. This was way before the modern welfare state existed.
Actually, scratch that. Let's just pause on this number for a second. 33%. The sources highlight that at their absolute peak around 1910, roughly 1/3 of all adult American males belonged to these fraternal lodges. That is a massive scale. This was absolutely not some niche hobby. This was a mass-market mutual aid system where members paid weekly dues to actively protect each other against unemployment, sickness, and death. And because these guys were highly accountable to one another, fraud was basically non-existent. Look at Method 14, the Oddfellows sick benefit. If you got hurt, a lodge brother literally delivered a hot casserole and a weekly wage check straight to your front door. Compare that to today's short-term disability claims that face massive 15% denial rates. Method 15 gave widows pensions, years of private, reliable financial support. And Method 16, Traveler's Aid, if you were stranded in another city, showing your lodge card got you a free meal, a cot, and a towing loan. It was a completely distributed safety net, built 100% on shared trust. Rounding out our 20 lost methods, we see community trust in its ultimate form. Method 17, fraternal building associations, had members pooling money and physically building homes for each other month by month. 18 was lodge bonding pools, backing local business owners with community guarantees. 19, if you lost your wallet, the emergency cash protocol gave you money, no questions asked, protected purely by your social reputation. And Method 20, the assessment roster. When a member had a medical crisis, a paper roster was passed around to raise funds immediately. The sources note this had a 98% success rate. I mean, that absolutely puts modern digital crowdfunding campaigns to shame.
Okay, so what happened? Let's pivot to the pattern break and reveal an uncomfortable truth hidden in the data. The death of social capital directly correlates with the decline of middle-class financial stability. For decades, we've treated the social world of community groups and the financial world of banking as totally separate things. But the historical record shows that social capital is actually the very foundation, the substrate, that makes financial capital work for ordinary people. Trace this timeline with me to see how this all unraveled. The explainer shows how suburbanization, rederegulation, and financialization systematically dismantled this community framework over several decades. In 1964, American Civic Association hit its peak. But then, as people dispersed into the suburbs, those in-person social networks started to fray. Then came the Deregulation Acts in 1982 and 1994. These laws allowed local mutual banks to convert into for-profit corporations or just get swallowed whole by national megabanks. And that brings us to 2024, an era of digital isolation where local underwriting has been completely replaced by centralized algorithms. And the economic shift here is stark. The data illustrates that as civic organizations disappeared and social capital plummeted, wealth concentration at the very top absolutely exploded. Back in 1960, the top 1% held about 10% of the wealth. Today, that number has surged past 30%. The decline of these mutual, locally anchored institutions meant that the profits from everyday lending stopped circulating within the neighborhoods and started flowing directly out to distant shareholders. This quote from the source really hits the nail on the head. Without community vetting, the bank has to charge more for risk. Trust was the collateral. The crucial takeaway here is that when you lend to a neighbor, you price in context. But when you lend to a total stranger, the system prices in uncertainty. If a local credit committee knows you're a hardworking member of the community, the social fabric itself acts as a partial guarantee. An algorithm? It only knows statistical risk, and it's going to charge you a hefty premium for that unknown. And this brilliantly illustrates the real, tangible cost of that algorithmic trust. In 1965, an entrepreneur might secure a $5,000 loan at 6% from a teller who knew their family. Today, that exact same person might have to take a $5,000 loan at a whopping 29% APR from some faceless app. That 29% APR is quite literally extracting thousands of dollars right out of the neighborhood and handing it over to the financial sector. That is wealth that isn't paying for college, it isn't fixing up a home, and it isn't being spent at the local grocery store. And to put that into perspective, today, only 9% of families rely on informal community lending. That is a massive, steep drop from 28% back in 1989. The overwhelming majority of us are now totally dependent on commercial credit. We basically traded in these localized, incredibly flexible safety nets for a system that looks more efficient on paper, but is deeply, deeply fragile whenever real-world economic shocks hit. I mean, summarize these numbers in your head. The sheer scale of this institutional collapse is staggering. It effectively wiped out the financial safety net of the working and middle class. We are looking at a 50% drop in civic engagement. Over 1,000 mutual savings banks vanished through conversions and mergers. The total number of credit unions has been slashed in half since the 80s, and unionization rates dropped from 35% down to just 10%. The very infrastructure that mobilized our trust into usable capital has been completely eroded.
But hey, it's not all doom and gloom. There is a roadmap for revival here. The blueprint still works, and modern variations of these lost methods are already springing up all over the place. People are finally waking up to the fact that financial resilience isn't built in isolation. It's built in proximity.
As the explainer highlights, newer generations are actually adapting these exact lost methods. Using modern fintech wrappers, they're creating 21st century mutual aid pacts. For example, groups like Common Trust are running digital death benefit circles, essentially reviving the old burial societies and getting a 0% default rate. We're seeing modern time-making networks where neighbors earn credits for elder care or fixing a roof. Union Milk credit unions are making a real comeback. And CDFIs, community development financial institutions, are focusing entirely on providing microloans right back into underserved local communities.
Which brings us to this incredibly powerful realization from the source text. Wealth isn't just what you have in the bank. It's who would show up if the bank closed. True financial resilience is built through human connection. At the end of the day, algorithms do not build safety nets. People do. The historical methods we covered today were powerful precisely because they treated money as a shared community responsibility, not just some isolated individual competition.
So what can you actually do about it? Well, the explainer outlines 4 concrete, actionable steps to start rebuilding that handshake economy in your own life. Step 1, move your money. Join a small, local credit union, ideally one under $100 million in assets that still actually practices relationship lending. Step 2, start a simple savings circle with just 3 trusted households for emergency funds. Step 3, talk to your HR department and ask them to set up a Christmas Club direct deposit to automate your savings without any fees. And Step 4, actively choose to support mutual insurance companies that return their profits to policyholders rather than to stock insurers.
Look, we don't need to hop in a time machine or resurrect secret lodge rituals to reclaim our financial stability. We just need to go sideways. We need to intentionally rebuild trust and proximity in our own daily lives. So I want to leave you with this provocative question to chew on. What is your first step going to be to rebuild social capital and wealth right in your own neighborhood?